All right, so we've done a lot of case studies for films, and I'd like to do one for a television series. So here is our case study, Kill Me Now, the TV series. So it's not much different with a TV series as it is with our movies when we put together our revenues and our pre-sales. So the budget, which is what we first define, is $25 million. Now the strike price, which is the actual cost that we pay during the production, is $23,125,000. And how we get there, how we get to the strike price, I'm going to get into in a moment. So let's look at our gross distribution revenues. We have US and Canada pre-sold to Netflix for 35% of the budget. That's $8,750,000, and we're estimating our international sales to be 70% excluding Canada, so that's $17,500,000. So altogether our gross distribution revenues should be $26,250,000 after everything is said and done. So let's look at what we actually have right now in hand. So if we take Netflix, for example, that who licensed the US and Canada for 35% of the budget with $8,750,000, and then we take our international pre-sales, which in this case are 30% of the budget, we add $7,500,000 to the pot. So what we have right now in contractual pre-sales is valued at $16,250,000. What we're getting in cash is only the down payment, and that is 10%, $1,625,000. The sales agent agreed to defer all sales fees into the recoupment corridor, so we do not have to pay any sales fees here. So right now what we have in hand at this moment is our down payment of $1,625,000. As I've mentioned in the case studies we did before, when we do pre-sales, which is great, we do get contracts. So we have paper in our hand, which is fine, but it doesn't really mean anything unless we find a way to get money out of that paper. And the way we do that is we take our pre-sale contracts to the bank will review those contracts and will cash flow them. The bank will always apply a discount, and that discount has to do with the various distributors who we enter into contracts with, and the bank will kind of level out how much they will actually want to give us for that. So in our case here, all the pre-sale contracts that we have handed to the bank are discounted to 80%. So our pre-sale amount of $16,250,000 earlier becomes 80% of it, which is $13 million. We do have a down payment of 10%, which is $1,625,000, and that we have to deduct. So what we're left with is $11,375,000. And then the bank applies the interest for that. And the bank in this case gave us a blended interest rate, which means they put together the pre-sale loan and the gap loan, and they blend it all together, and they give us one interest for the term, which in this case is 2 years, so they're charging us 9% for the entire term. So we're paying $1,023,750 in interest for our pre-sale loan. So if we deduct this, we end up having in our hand for our pre-sales $10,351,250. So next, let's go to our gap loan. Let's see what's going on there. So remember that our entire bucket of rights that we have available in the beginning when we started out was $26,250,000. And of that, we had sold international pre-sales and the US. So we've sold together $16,250,000. So now we have to deduct this number, and what we still have to sell ends up being $10 million. Now the bank will look at that and say, good, but I will only use half of that for the collateral, and I'll only pay you up to 20% of the budget. Now, in this case, half and the budget cap happens to be the same, so it's $5 million. And the bank will obviously deduct its interest of 9%, and it will also deduct a loan fee of $50,000. So that gets us $4,500,000 for our gap loan. So altogether, our bank loan is going to be $14,851,250, which we can put in the bucket to cover our production costs with. What we have to recoup, though, later is the gross bank loan of $16,375,000, because at that time we have to pay the interest and the loan fee, because we're not paying it right here. It's being deducted, but we're not actually paying it to the bank. We're not issuing a check to the bank for these interest fees and loan amount. So we have to pay this in the recoupment phase. So now let's put together all our funding sources and put it in a nice little package, so we know how much money we've actually put together to finance our TV show. So we did get our senior loan, which was $14,851,250. We also got our down payment for the pre-sales that we had done, which came to $1,625,000. Now, for the production incentive, we did a co-production with a Canadian producer because we're shooting our television series in Canada. Now, the incentives in Canada only apply for below the line in this case, so we don't really get anything for above the line. And our below the line production costs are $18 million, and for that we get 30% in Canada. So we are looking at $5,400,000 in incentives, and our producer is going to charge us a 5% fee on that amount, which is $270,000. So we're left with an incentive of $5,130,000 that we can use to cover our production costs. So next thing, we got crowdfunding of $250,000. We pay the admin fee. We end up with $212,500 available to cover our production cost. Brand integration was $350,000. Obviously, we pay the agency, so we're left with $262,500. In this case, the brand integration company agreed, or the brand agreed, to give us the money all up front, so we don't have to split it up as we usually do. In the beginning 50% and then on delivery 50%. Here for a TV show, they pay everything up front. And for our in-kind services, we did a deal with post-production house that says 15% of your budget is going to be the post-production budget, and we will agree to defer 50% of the post-production budget, and we'll charge it to you later in recoupment, and we'll also charge a premium on that, because obviously we're taking a risk by taking out 50% of the post-production and recouping it later. So we're going to charge a premium because we're taking a risk. That's what the post-production house says. So that's how that works. But the post-production money is not actual physical money. It's only a deferment. So what we do, we take this amount and we deduct it from our production budget, because in actual fact, all we do here is take a budgeted line item and eliminate it for the portion that it's being deferred for. So we're not getting cash, but we're getting a deferment, so we can eliminate those costs for the production period and deal with them later in the recoupment corridor. So we're now adding up all the cash portions that are made available to us, which is the senior loan, the down payment, the net incentive, the net crowdfunding amount, and the net brand integration. And all that gets us in cash $22,081,250. We have to cover the strike price. Remember, the strike price was $23,125,000, and we have to cover that. And in order to do that, the balance would be $1,043,750, and that is also the amount we will be receiving from our equity investor. So now we covered our strike price and can go into production. So we've produced our series, fantastic, and now we can go into the recoupment scheduling and see what is happening as money comes in, as our distributors pay us, as we sell all the unsold rights that we still have to sell. So what does it look like? We're now delivering the series, and here's what we're looking at. For the international and US distribution revenues, we actually get what we estimated, including the pre-sales and our unsold estimates. We're getting $26,250,000. Now, we did already receive $1,625,000 in down payments from our distributors, so we have to deduct that, and that leaves us with $24,625,000 in worldwide distribution revenues. So now that we received our revenues, we have to deal with some expenses and repayments and deferments and so forth. So what does that look like? So now here are our expenses. First in line of our waterfall is the collection agent. The collection agent is going to charge us a 1% fee, and that is 1% of the worldwide revenues. Remember, our worldwide distribution revenues was $24,625,000. So the collection agency fee is 1%. It's $246,250. Next in line is our bank loan. And remember, we're paying the gross bank loan back. That is $16,375,000. The sales agent is next in line. So they're charging us a 15% fee, and that is 15% charged on everything, including the down payment, because remember, we didn't pay him his sales fee for the down payment yet. So we have to pay it now. And this sales agent charges us a fee on all the worldwide rights, not just the international, but all of them, because the sales agent was responsible for getting us the Netflix deal. So in that case, we're looking at 15% of $26,250,000. Again, it includes the down payment because we haven't paid for that yet. We also pay 1% distribution expenses. So altogether, we're paying the sales agent fee and expenses of $4,200,000. Next in line is SAG. The guild is going to get paid $50,000. They requested to be sitting in waterfall behind any distribution costs that we have in our senior loan, so that's why we're putting them here. Next in line is our equity. The equity amount that we received was $1,043,750, and under industry standard terms, we are paying a 20% premium of $208,750. So altogether, we have to pay our equity investor $1,252,500. So now at this point, we can pay our post-production house, and the deferment amount was $1,875,000, and now we're paying this. We're also paying a premium on that for 10%, so we're paying an additional $187,500. So altogether, the post-production house receives $2,062,500 from us. So if we're putting all these repayment and expenses together, we're looking at total expenses of $24,186,250, and that we're going to have to deduct from our worldwide distribution revenues to get to our net revenues. So now, after we deducted our expenses from our worldwide distribution revenues, we end up with net revenues of $438,750. So this is the time when we pay all our profit participants, and we pay them at the same time. Remember earlier when we paid back all the people in our expense columns, we paid them in an order of ranking. That's a contractual order of ranking that has to do with A, what did you agree with these various financiers and funding sources as to where they will sit in the waterfall, and B, what are the industry standards. So both are applied in the waterfall, but here when we do our profit participation payments, everyone gets paid at the same time. So that is why we're paying off the $438,750, 2.9% to the equity investor. That's $9,158.91, and it's 2.9% because it is 50% of the amount financed in relation to our budget. And the equity investor, as you remember, when we put together our funding sources, financed 4.18% of our budget, and half of that is 2.9%. So that's why they get 2.9% of our profits. The director, showrunner, and our talent is going to get 15% each. So that's $65,812.50 for each of them. So that altogether has us pay everyone $206,596.41. Now we're left with $232,153.59, and we agreed with our co-producer, the Canadian guy, that we would split that with them. So whatever the balance is, we would split halvesies. So each of us gets $116,076.80, and that's what we share for profits in the end, and that's what we're making with the television series in profits for the first season. We're only talking about the first season here.